Before we get started, I'm going to talk about tax stuff in here. This isn't just a software demonstration or anything like that. So by way of disclaimer, nothing in here is going to be tax advice. If you're in the business of giving tax advice, don't use anything in here as the primary source for you giving that tax advice. This is informational, this is product related, this is us trying to make sure that advisors are looking at everything they can possibly look at and using Holistiplan to help them do that. Hi, I'm Roger from Holistiplan, and in this video we're going to talk about tax return reviews with respect to 2020 unemployment compensation. It's a real mess, but when things are a real mess, that's potentially an area for a well-prepared financial planner to make a real difference for their clients. So we're going to start with just a review of the rule changes that came down on March 11th of this year. We will look at a couple things in the system, and then we'll finish with an opinionated action plan that financial advisors can do specifically as they're reviewing returns that have unemployment compensation. All right, so March 11th, 2021, the American Rescue Plan Act, ARPA, was signed into law March 11th of 2021, even though the law impacts taxable income unemployment compensation that happened in 2020. March 11th, a lot of people had already filed tax returns under the assumption that their unemployment compensation would be taxable. That's really the big issue we're dealing with here. What did the rule say? The first $10,200 of unemployment compensation for each taxpayer on the return would be excluded from taxable income, provided the modified adjusted gross income was less than $150,000 on that return, regardless of filing status. Now, what is the modified adjusted gross income for purposes of this? That's your AGI minus the unemployment compensation. And that was something that only came out like a few days after the bill passed, was this determination that yes, the modified adjusted gross income for purposes of this calculation, AGI minus the unemployment compensation. So what do we have out there? We have a universe of tax returns, some of which were filed before this change happened, and some were filed after. And part of our job, or part of your job as the financial planner, is to make sure you're looking very carefully and closely at these returns and making sure we're especially catching those where your client is entitled to some money back on their taxes. That's where the real value add can be. So how do you know? How do you know if your client filed it properly after the law changed, or is it one of those that was filed before the law changed or filed incorrectly after the law changed? Well, the first thing we need to look at is all the action here is on Schedule 1, lines 7 and 8. So if you look at Schedule 1, line 8, here's an example here, it's just handwritten, so we know it's not real. If we look at Schedule 1, line 8, you see UCE, Unemployment Compensation Exclusion. And if you see a negative number, or if you see a number on there, you know that some element of whatever is happening on line 8, some of it represents unemployment being taken out of the taxable income for your client. Now, if that is left blank, or if there's no mention of UCE on that line, on line 8, then one of two things happened, okay? One, it could be that the AGI, or the modified adjusted gross income for this client, was too high. It was, AGI minus unemployment compensation was over $150,000. Therefore, they weren't eligible to exclude unemployment, and so no changes required, right? So no changes required. If you see UCE, that means they've taken that exclusion. Second of all, if AGI is too high, then they weren't eligible for it. The third case, though, there's no mention of UCE on there, and they were eligible for it but didn't take it. And so those are the ones that you really need to watch for. And you'll know if it doesn't say UCE, if the AGI minus unemployment is less than $150,000, that's one you mark, and that's one of the ones you got to follow up on. Just as a sidebar, by the way, when we talk about reducing taxable income or excluding unemployment income or using this MAGI, it does get added back or rather the piece that you exclude, you do have to add back for a few calculations the amount of taxable Social Security. It gets added back. Some deductions like eligibility for the IRA deduction, student loan interest deduction, I believe tuition and fees. So just know that if something funky's happening with a phase out over there, when you think, well, that's interesting, I thought my AGI was lower. Well, AGI for purposes of calculating those things, some of those things I mentioned, you have to actually add back the exclusion that you took out. All right. So what is Holistiplan doing about this? Well, first of all, when you upload a tax return that has any unemployment, anything on line 7 of Schedule 1, we're automatically failing that. So like the OCR process will run, it'll read in the fields, and maybe everything reads in fine, but we're going to fail it and we're going to take a look at it because we're trying to do our best to just get a handle on what's going on too. And so when we see an example of one where the AGI is less than $150,000 and there is unemployment compensation but nothing on UCE, we're going to flag that. We're going to do our best to catch them all. We're going to flag it and we're going to send you a note that says, hey, this one looks like it might be on this list. And we're going to put in something that we think could be the amount. We're going to make an educated guess as to what we think could have been excluded but wasn't. An educated guess, why is that? Well, in some cases it's really easy. Like if the total unemployment compensation is $5,000, well, that's less than the $10,200. So we know that the amount that could have been excluded is $5,000, all right? But if the total unemployment compensation is $13,000 or $12,000 for a filing joint return, well, I don't know, was that one person, in which case $10,200 could have been excluded? Or is it two people, each receiving unemployment, in which case possibly the whole thing could have been? We don't know that, and honestly, it's impossible to tell that from the tax return. Which brings up an interesting point about the IRS's promise to just automatically figure out what people should have paid in taxes and automatically do refunds without you having to file an amended return. Seems unlikely because the information is not on the return to do that. Now, admittedly, they can go back to the 1099s, but hold on to those returns. We're going to have to see how this thing plays out. A few things you'll see in our system. You'll see on the scenario analysis screen, again, like these are us doing our best manually to capture some of these things that are happening. So if we see UCE, we're trying to capture that and show that, just so you can see in scenario analysis. Here it is. This is an example where this tax return had unemployment compensation actually excluded properly. You'll see that amount showing up in line 8, additional income, as a negative, but we also are showing here's what is being excluded. Here is an example of where we took an educated guess as to what looked like it should have been excluded but was not. And also we're going to note something in the tax report as well when this happens. But what you're seeing though is like it's difficult to automatically determine what was happening. Schedule 1 line 8 can have a lot of different income sources on it. So just seeing a number in that field doesn't mean they properly took out unemployment or not. It could be some other type of income they were capturing. All right, so the action plan. This is the opinionated action plan. I think, first of all, every advisory firm needs to make a running list, either on the whiteboard in the office, if you're back in the office yet, or if you're working remotely, have a shared spreadsheet where you list every single client of yours who had unemployment compensation last year. Just make a running list. Every single return you see, add them to the list. No one comes off of that list until you are certain that they have received any refunds or their tax calculation has incorporated that unemployment exclusion properly. So if they have the UCE marking on their tax return, okay, fine, they can come off the list. If their AGI is like $800,000 and there's no way you could get it down under $150,000, okay, they come off the list. But everyone else should stay on the list until you're absolutely certain that either they've amended their return or the IRS has figured out how they're going to pay people back. Keep it on the list and just keep watching it, because this story is not over with. Now, I mentioned getting the AGI down. we still have some tools available to us. I'm recording this on March 30th. There's still some tools available to us to get AGI down if we're right over the edge of that 150,000. That is a cliff. So you got to get it, if you're close, you got to do anything you can to get it under 150, and then all this unemployment compensation becomes tax-free. First, review filing status. As far as we know, that 150,000 MAGI is for any filing status. So is it possible that a married filing jointly would benefit from switching to married filing separately? Now, there's a lot of other stuff that goes with that. The brackets change, the ability to deduct, or the ability to get a credit for dependent care changes. A lot of things change, but you might just look at that. If it's borderline, that's a way to bring potentially $300,000 of AGI down to $150,000 of AGI. So that's one you're gonna have to run some numbers on, but that's an option potentially. Still time to do that IRA contribution if it's deductible, depending on the circumstances. Still time to do that HSA contribution. Still time to do the SEP IRA contribution before filing that tax return. So that's a way potentially to bring the AGI down. If there's business income at all, is there a way to, within this business, to accelerate some bonus depreciation, something like that, trying to bring losses or expenses into the year to try to get AGI down? And I suppose if you're really desperate and you're like just a couple $100 away, maybe even look at that little $300 above the line charity deduction. Even if the itemized deduction is bigger, maybe it's beneficial to switch to the standard and take that $300 above the line deduction if you're like really that close to getting it under 150,000. But there's still time to work on the AGI if someone's borderline there. Now, as far as modeling this in Holistiplan, we made a decision to not attempt to automatically pull the unemployment compensation out. There's too many things that we don't know. We don't know, in the case of a married couple, who is getting what. We don't know if they've already captured the unemployment compensation exclusion or not. So you're going to have to model it. If you're trying to model one of these things about lowering AGI or something like that, or to see just how much money is at stake if they exclude the unemployment, you will have to model it. And the way you model it is the same way it's happening on the return, which is you find out how much unemployment compensation went to each spouse, if it's two people or just the one, and then the maximum you can do is $10,200. And then you have to check to see if they're truly eligible based on the AGI. It's not there at present, but as of tonight, we're going to add a little flag that'll say, yes, this person, if you take AGI minus unemployment compensation, yes, it looks like they're under that $150,000 limit. So you can do some of this modeling and scenario analysis. But going back to my original thing, which is make a list of every single client who took unemployment compensation last year, and do not take them off that list until you are absolutely certain that you and they fought for every dollar that is available to them based on the new ARPA law. Because there's so much floating around about how the IRS is going to do it. I could see it kind of falling through the cracks. And that's how we as financial planners, financial advisors, can really provide value to our clients. One, by just explaining what the heck's going on. And then two, fighting for those dollars for them to make sure that they're not overpaying on their tax.